Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
All right. So I'm sure some more will kind of trickle in as we get going, but I just want to welcome Dr. Menaker to a great session here. It's 8 p.m. on the East Coast, March 3rd. This is Hedgeye and Friends. Dr. Menaker sat down with Trent and I last year. We'll probably review a bit of kind of his background and just going to kind of get him reacquainted with the group in case people aren't familiar with Dr. Menaker, but he is a clinical psychologist and has worked with Department of Defense, the U.S. Navy. He's helped navigate folks from a tactical managing kind of like tactical risks and environments that are very high stress, and that is translated into a sort of a transition to helping both individual investors and traders, as well as portfolio managers and leaders in their business communities, et cetera, et cetera. So I'm incredibly excited to kind of rekindle our conversation from last year, Dr. Menaker. So welcome. I appreciate your time, and I think we're going to have a great combo here. You're on mute, though. Hopefully you can hear me. Let me see. He accepted my co-host invite, and we just gotta get him off mute. All right, guys, 1 second for a little technical issues here. We will sort them out. So Dr. Menaker, unfortunately, I can't unmute you, but if you try to do it on your side, it should work, and we can get the conversation rolling. All right, so I'm just going to ask you to come up, invite to speak. All right, Dr. Menaker? All right, he's back up. Hopefully it worked this time. Can you unmute yourself?
Hello, Rob.
Hey, Dr. Menaker. There we go. We got it. We got it sorted out.
Yeah, cooking with gas. Yeah.
Well, thank you again for your time and consideration kind of having this conversation with us this evening.
Yeah, thank you. And by the way, call me Andrew, not Dr.
All right.
Menaker.
Perfect. Yeah, so again, I mean, I don't want to kind of completely rehash the conversation last year, but it's likely a great place to start off. I know you're a big component in terms of your inner market is what you call it, and kind of harnessing kind of that all of the kind of getting your body right in order to get your mind right in order to execute properly out in the market and trying to kind of generate that alpha, as we like to call it, right? So maybe you can kind of just give a bit of a background as to how you sort of came to calling it the inner market and sort of how you really kind of came to that kind of concept and stuff like that. That'd be great.
Sure. Well, it was a result of several aspects of my life kind of coming together. When I was in grad school, I wanted to go into sports psychology, which didn't happen. I realized as I was trying to get into it that you actually have to have connections in the sports world, which I didn't have. So that didn't work out for me. But I realized that using psychology and performance was really where I wanted to go. And so I just by happenstance I ended up getting a kind of a consulting gig with the Defense Department, and that led to working with Wells Fargo and all kinds of other things. And what I did essentially is I brought in the idea of it's not just our mind that is facing opportunity and risk and uncertainty. Our body is also reacting as well. our body and our mind, as we know, work together. There's a lot of synergy there. And if you take care of one, it helps the other. So that was a big part of my kind of the beginning for me working with traders and also doing my own trading. I realized that it's not just about the gray matter between my ears. One nice little example, if we're sleep deprived, you're going to perceive risk really differently. Most people are going to be more willing to take on extra risk more than they normally would when they're tired. There's all kinds of examples of how what I call the internal data or the internal market, how it affects what we see when we're looking at the screen, how it affects it affects how we judge what we see, and it ultimately has a huge influence on how we interact with what we see. So that's that inner market. It's everything to do with our feelings, our concerns about how we appear in the eyes of others, our clients, our family, our neighbors, strangers on Twitter, everything. Yeah.
Yeah. So when you're in that state, or if you do find yourself in kind of either slightly sleep deprived, let's just say, you're traveling for work, you're going to a conference, and you're on you have to take a red eye for whatever reason, or you're like Trent Wizzo, who put us in touch and put us together and helped kind of spearhead this rekindling of a conversation. He had a baby last fall, right? So when you got any kids really, whether they're 1 or 31, you still always you worry about them, right? Or they can keep you up at night.
I'm a parent myself.
Yeah, exactly, right. So, but my question is really, how do you coach people that are kind of trying to execute at the highest level to be cognizant of what's happening, kind of outside of your own process, right? At Hedgeye, Andrew, we're big process. We're really big process guys. Or I'm Canadian, so I say process, but as an American, to be process, right? So we're big process guys, right? In terms of doing consistent things over and over again. Price volume volatility is a big piece that factors into our signal that drives a lot of like the execution in terms of the when and the where. So again, kind of getting back to my question, it's you can dial in your process, but if you're not, to your point, like kind of mentally there, or if you're not, or you're mentally there, but you're in a different kind of state than your usual state of mind. How do you typically kind of coach folks that are executing? Whether it be portfolio managers or individual investors, how do you kind of help them through that thinking about that concept?
Sure. Well, I'll use your specific example about the issue around sleep and process. So, as a trader myself and in my work as a coach with traders, one of the main things I remind people of, because it's easy how everyone forgets this, that we don't control the outcomes. We can't control the direction where the trade's going to go, but we can control the process. And part of the process is not simply identifying opportunity, doing your research, looking at charts. Process also includes managing yourself and even assessing yourself. What kind of shape are you in, right? So if you're tired, really sleep deprived, it may not be the best time to be initiating a large trade, or if it is, maybe you want to, if you have some help, have another pair of eyes. The basic idea here is to recognize that you, the operator, are a big part of the process. It's not just what we do in terms of analysis. So, if it's possible to take a nap, possible to take a break, do you have to put on positions? Do you have to manage a position when you're tired? Those are the things I would be suggesting that people think about. The idea of process it's a big one, and I'm 100% with you on this, Rob. It's all about the process, man. It really is. But people don't realize what is involved in the word process. I think it's bigger than what people realize.
Yeah, it's a, I wouldn't say misuse, but certainly like many things in life, a terminology that's thrown around without perhaps fully understanding or perhaps used in slightly incorrect ways. And you're right, because I mean the beauty of what you're saying is I mean the internal process is just as important as the external, as in like what are you doing in terms of the reps that you're putting in, or the levels that you're setting, right?
Yep.
Like what you're seeing, sometimes we joke about, our brain sees snakes in the grass,
Yep.
right? To try to, well, it's not really a joke. It's proven
Yeah.
in terms of study, as I'm sure you know. But like, we joke, or some good friends of mine, we kind of like snakes on the screen, right? We're trying to avoid the snakes on the screen and making mistakes in that environment. So I think from so taking it one step further from a coaching standpoint, going beyond kind of stepping away from it, do you find that in your own personal trading that you'll either put on, like, if you're normal, so again here we've got mid max position sizing at Hedgeye, and we often, we kind of are a part of the process is to add to positions incrementally. So doing so, again, it varies per person and for everybody, but let's just say 25 to 50 basis points at a time. So if you're situationally, kind of your own body, your mind isn't in its perfect shape or condition, do you typically kind of tell folks or coach individuals to sort of be more on the cautious side,
more
right?
on the defensive side, if possible?
More on the defensive side, if possible, right?
If at all possible. I mean, of course, there may be times where you have to act, but if it's possible, a good way to think about it, Rob, just briefly, is that there's internal data and external data. The external data is the stuff that's outside of us, the research, the charts, the analysis, the fundamentals, the market, the economic calendar, all that stuff. That's the external data that lives outside of you. But then there's internal data. How do you feel? How much sleep you've had? Your feelings about your P&L, what your wife said to you this morning, all that kind of stuff. And the internal data, and I learned this early on in my career as a psychologist, doing threat assessment with the Navy and doing critical incident stress debriefing after bank robberies with banks and things like that, is that what's going on with our internal data influences how we see the external data. So it's really as simple as that. But I can go into detail, which I won't unless you want me to. But it's really about paying attention to the internal data, which is a big part of the process.
Yeah, let's maybe dive a little deeper if you don't mind. I mean,
Sure.
I think that'd be potentially really helpful for folks because, again, just personally. I mean, I'll just speak personally. It's almost like I'm getting my own coaching session. So for those listening in, if you got questions or you want to, you want to come up and engage, please. This is for all of Hedgeye Nation. But the day can get away from you. And what I've found, and something that I've picked up from our CEO Keith McCullough, is the compartmentalization of time, right? So basically there windows of time for and I'm giving him credit because I basically have taken it from him and tried to implement it in my own way. Now I'm not maybe quite as diligent in terms of like the trading windows, but he's very from Hedgeye puts on the macro show, and it goes from 9 to 9:30. At 9:30, the market opens, and he is at his desk in his front of his screens, running through his kind of screening process and going through his kind of portfolio, and really that goes from 9:30 to like 11, an hour and a half, and then similarly at the end of the day, from 2:30 to 4 o'clock. Those are really kind of his like typical like trading windows, and then the middle of the day is where he'll have meetings or do take care of other business. That doesn't mean that some days those things aren't on the calendar, so he has time to keep be in front of the screen and stuff like that. But would you that's a market practitioner from 25 plus years? Would you say is that a function or kind of a practice that is you have found while working with your various clients that's kind of compartmentalizing the time or breaking things up to execute in order to kind of have a clear vision or clear kind of mind? Would you say that's helpful?
Very helpful. In fact, I like to use the word structuring your time and space. Not just your time, but even your space, your workspace where you're working, right? So you have the ability to concentrate and do what you have to do. Yeah, structure and compartmentalization, definitely. Yep.
Awesome. So if we want to go like maybe a little deeper,
Yeah,
I don't know
yeah,
which direction you wanted to take it, but
yeah,
I'll kind of throw the ball back to
sure.
you, and Brad jumped up, so maybe you can expand on kind of going a hair deeper, and then we'll bring we'll bring Brad.
Okay. Well, I'll
Awesome.
just give people a really quick practical thing you can do in terms of this internal data and external data and how the internal data influences the external. Here's a quick short list. It's not a complete list, but it's a good starter list of what your internal data is. And there's two categories you want to pay attention to of the internal data. One of the categories is biological or physiological. It's the physical. It's how your body's doing, how much sleep you've had, if you've had a bunch of caffeine, or do you have a cold, do you have are your muscles tight? I mean, there's a lot of physical stuff, your heart rate, respiratory rate, all that kind of stuff. And then the other category of the internal data would be your thoughts and feelings, the quality of your thoughts and feelings, the type of self-talk, what's going on in your head, FOMO, worried about your P&L, it's the end of the quarter, end of the month, whatever it may be, you're about to put, statements out to clients. It could be a lot of different things. So the two categories of internal data is it's kind of more like the psychological and the physical, but they're both part of the internal data. And I think people should have a list for themselves of the things that they should be paying attention to in the internal data, not just the external data.
Yeah, that makes perfect sense. Makes perfect sense.
It's part of the process for me.
That.
Yeah.
Yeah, it
the
really
process.
is. I mean, yeah, exactly. Hey, Brad, welcome up.
Yeah, thank
How are
you,
you tonight?
Robert. Thank you very
Absolutely.
much. Andrew, good to hear from you. I have spent a lot of years getting towards the place you're talking about, and I'm way closer to that, but I want to give you maybe the next 12 months. Bear Stearns happened when I was sick. I remember the day I was sick and Bear Stearns happened, right? I've always worked out and yada yada, but I was a lot younger then, maybe more stressed. I'm way more calm now, but the next Bear Stearns may happen when all of us, well, God forbid, somebody gets COVID. Here comes Bear Stearns, the next Bear Stearns this year. So when you are down, right, couldn't work out, 2 days sick in bed, here this thing comes. There's a trick to coming back from your body doesn't feel well, your mental doesn't feel well, you get it. And what you're talking about, I aspire to every day. But when it's the antithesis, any suggestions besides breathe deeply?
Great. Well, there's a lot of different possibilities, and people are going to respond to these couple of things I'm going to suggest differently. Not everyone responds the same way, but one of my big tools, more important tools that I use for myself and that I teach my clients is a specific type of journaling, very specific. I call it drill down writing, where essentially it's a series of questions that you ask yourself. What am I feeling? What's behind this feeling? Why am I feeling this way? What is this feeling tempting me to do? Is that consistent with my strategy or my plan? When I have these feelings or thoughts, what have I done in the past? How has that worked out for me? Those types of questions, it's a very specific type of journaling that you need to do in the moment, right? When you're, facing whatever's happened, whatever the big catalyst that's happened.
Let's call it a kind of crisis, right?
A crisis, yeah. When the crisis hits, right? And there's always going to be a crisis. We just don't know when and what it's going to be, but we do know there will be more crises, right? That's the one thing we can pretty much bet on. When and how they show up, we don't know what it's going to be, but so it's good to have a plan for yourself in terms of what are you going to do when a crisis, the next one, shows up. So taking care of your body, the breathing deeply is a big one. I don't want to shortchange that. You do have to take care of the body, but you also need to address what's going on in your mind, all the thoughts and feelings that are swirling around. And it's incredibly powerful to take your thoughts and feelings and put it on paper. And I'll just say this, I'm a big proponent of using a pen and paper rather than keyboarding it. Get to some research that.
Us,
Go ahead, Brent.
us too,
Yeah,
Andrew. Us too.
good.
We're big
It's
notebook
old
guys.
fashioned,
Big
man,
big
but
Yeah,
notebook
yes.
guys.
you know it
All
works.
of us are way ahead of you on that front, but just with numbers,
Yeah,
not
You,
feelings.
yeah. Well, hey guys, there's a really good reason for it too. So, a couple of reasons. One is we're more committed, more connected to what we're writing when we use our thumb is when our thumb is involved. Because when you're keyboarding, your thumb pretty much only hits the space bar for most people, unless you're a really horrible finger
yeah.
picker like me. Um, but most of the time, your thumb is not that active when you're keyboarding. And there's a lot of nerve endings in the thumb that go right into the brain, near the language processing areas of the brain. And so when you're writing with a pen, you're more engaged with what you're writing. Not only that, but you'll remember more what you wrote. And they've done this with research with college students actually down at Stanford, just down the road from where I live, showing how students who take notes on a laptop versus handwritten notes, the students who take notes on the paper, handwritten, have better recall. So, yeah.
That's awesome. I knew that just personally, but I didn't know that there was actually
Oh, yeah.
scientific
No, there
evidence
is.
there too.
Yeah.
uh, Along your lines, so Brad was kind of talking, or the way I interpreted your question, Brad, was a bit more about market events or larger market events, right? Like kind of like drastic things that happen there. I'm assuming, Andrew, that similarly journaling events, whether it be catastrophic or just things that are happening outside of the market environment,
Yes.
would
Oh,
fall into that
definitely.
journal.
Oh, yeah.
Yeah.
Anything going on in your personal life or in your business or something with your clients or your family or anything. It's not just about market stuff you want to be doing this drill down live journaling with. It's any kind of issue that pops up for you at all. Um, it's a great way to address it. It's part of, for me, it's part of self-management. Um, one of the ways I think about it, I'll just say this briefly, we can explore it more if you want, but so our emotions and our thoughts are basically fuel. It's gasoline. Our trigger finger goes over and hits the buy or sell button. It's the execution, but there's fuel that's needed to do that. And our thoughts and feelings are the fuel. And so if you don't know the quality of your fuel, what's going on with your fuel, you're going to be executing blindly, or not blindly, but kind of relatively with lower awareness as to why you're executing. So yeah, it's really, really important.
So do you find any character, like with your work, Andrew, and like working with folks? Do you find any character traits, or that might not be the right classification of words, or how you would call it out? But do you find people that are either more even keel or just kind of less, again, like more emotional, or that makes sense at all? I mean, I
Yeah,
don't want to be like psychopaths, but like basically,
yeah,
like like folks that like maybe the Dexters of the world or whatever, right? But who don't actually murder people.
right. Well, here's what's really interesting, Brad. People that you think are as cool as a cucumber, they speak really calmly. Maybe they're on CNBC and they just seem like they're just cool as a cucumber. In reality, when they're under pressure, it can be an entirely different person. Now, there are some people, a very small number of people, that have sort of a naturally high degree of equanimity, which is kind of what you're describing. They don't get too high or too low. They're kind of just even keeled. Not very many people are like that naturally. And even those people who are like that naturally are going to get pushed off their center at some point. So to aspire to that is nice, and there's things you can do to aspire to that equanimity. But the reality is, most of us are not going to be, at that place all the time. By the way, when you do get to that place of sort of being balanced and things don't bother you, that's part of the recipe for getting into the flow, getting into the zone, right? That's like for an athlete or whatnot. And when I used to surf big waves, it's like you don't want to be worrying and thinking about things. You just want to be in the moment.
Well, that wasn't Brad asking that question, but I did do a series for ESPN Films called Enhanced. It's only on ESPN Plus, and the episode is called Mind Gurus. Thank you, Andrew. I appreciate your input on that. I'm getting closer. We're all striving to get closer and closer every day to the flow. Thank you.
Mm-hmm.
That's awesome, Brad. Hey, Brad, can you just say that one more time, man? It's on ESPN
Yeah, I
Plus.
did a series for ESPN Films. It's on ESPN Plus called Enhanced. There's one episode
Cool,
called Mind Gurus. It's
Mm-hmm.
cool.
yeah, Kerry Walsh Jennings and a lot of really good input along the lines of what Andrew's talking about. He'd actually know a lot of the people
Yeah,
in the
yeah.
episode.
Most elite athletes, the vast majority of them use mental coaches. Most professional sports teams, the U.S. Olympic training manual requires that all coaches bring in a mental coach at some point for their athletes. It's pretty much any kind of elite performer. It's an edge. It's a form of edge, really.
And so, one of the things that I've read of yours is leaning. A lot of folks don't talk about like intuition
Mm-hmm.
or really or almost consider it or might
Gets a
put it
bad
into a
rap.
different type of
Yeah.
bucket. Yeah, it gets a bad rap, right? Like, it was like a gut feeling or
Yeah.
whatever, right?
Yeah.
So, but or they try to place it into like a different bucket, in order and kind of bake have it be part of their quote unquote process. But I know I think we talked about this a bit last year, but I would love to kind of go back
Mm-hmm.
into it because
Mm-hmm.
I do think there is
Mm-hmm.
absolutely a level of
Oh yeah.
intuition that can separate you as a good trader or a bad
Oh
trader,
yeah.
and whether it's a portion of kind of checking. I don't know. It's not really checking the emotions at the door, but just being aware of your emotions,
Yeah.
and therefore either not
Yeah.
executing or leaning into that and being like, okay, yeah, all right, like I know I'm feeling this way, but I'm trusting, the data that I'm seeing, the process that I've built, and I'm going to
Mm-hmm.
almost like execute
Mm-hmm.
anyway, but maybe
Mm-hmm.
do anyway. But yeah, so
Yeah.
I'd love for you to kind
Yeah.
of expand on that intuition
For
piece.
sure. Well, the first thing I'll just say is that very successful traders use their intuition. They may not talk about it publicly, especially if they're running money, because they don't want their clients. And people get scared, they'll get worried, right? They're going to want to run for the hills. Why is this guy using his feel? I thought he was using his analysis and his research. So it is used by very successful traders. They don't talk about it. So that's the first thing. The next thing I'll just bring up is this. There's a lot of ways to define intuition. One of the more common ways to define it is that it's essentially implicit pattern recognition. What that means is over time, with experience, when somebody's been trading for years, like I've been involved in trading for many years, since the late 90s, when you have a lot of years under your belt in any kind of activity, whether it's trading or skiing or whatever it may be, the more you have experience, the more you've learned subconsciously, not just consciously about what you have to do to execute and do what you want to do, but your mind has learned things implicitly that you don't even realize you've learned. And that's a big part of intuition, is that implicit pattern recognition, things that you can't really share with other people. You may not even be that aware of it yourself. Question is, how do you tap into that? First of all, I just want to reiterate that for people who are relatively new to trading, and I'd say new would be a couple of years, don't even think about intuition yet, because the reason why it gets a bad rap, rightly so to a degree, is because there's a lot of people who take horrible trades because of their feel, but they're inexperienced traders. If you're very experienced, it's one thing to take a field trade versus someone who's not that experienced. Extremely different situation. But I will say one of the first things you have to do, and this is big focal point in my coaching, is before you can tap into that implicit pattern recognition and understand it and execute on it, is you have to be able to distinguish your emotions, things like fear and hope and fantasy and things like that. You have to be able to distinguish your emotions from your intuition. You have to be able to differentiate that. And that is where a lot of the work is that I do with my kind of larger professional clients, because they want a place where they can kind of refine that, but they can't talk about it publicly. They can't talk about it with their clients, certainly, and they probably don't even want to talk about it with other people at their firm, because it may not be a good look for them, right, to appear that way. But in reality, in the privacy of a one-on-one consultation relationship, like with a PM, with a portfolio manager, oh no, they're always asking me about ways they can refine and recognize their intuition. Yeah.
And when something new kind of pops into the market, right? So I'll just use like 0 days to expiration, in terms of the option flow that's occurring certainly year to date. How do you help some of those folks kind of adjust or pivot in terms of, okay, like you're a seasoned vet or and you have all this sort of built up intuition and this kind of emotional intelligence, these pattern recognitions that you can see, but now there's almost kind of like a new pattern that you have to kind of incorporate. So, and the market's always ever
like a regime change in the market kind of thing too, right?
Yeah, exactly. Yeah. And zero DT is just like one. I mean, you can go back over the course of the last 20 plus years, and there'll be different components that you'd have to be in the early 2000s. You probably would have to incorporate more of kind of fast money hedge funds, right? And in the flow that the capital flow that they were influencing on the markets, and then it's transitioned a lot to passive more quote unquote passive flows and target date funds over the last sort of 10 years, and adjusting. These are like bigger shifts, but adjusting to these kind of new these new capital flows and the influence that they might have on the markets. I'm just kind of curious how you might coach people in terms of like kind of trying to recognize new patterns or that kind of thing.
Yeah, that's a great question, man. It's a big question. There's a lot there. So first thing is to be able to recognize and be able to acknowledge that there may be a pattern shift, there may be a change in pattern, and recognizing what could that mean for me. And a lot of it starts with just awareness and acknowledgement. I have a saying that I like to use a lot with my clients, and we kind of unpack it, but the first line of the saying is this. It's sort of a paragraph that I like to use, but the first sentence is simply this: increased self-awareness leads to increased market awareness. And I can tell you, man, from my own experience as a trader, as well as working with many, many traders, I've been doing this for over 20 years, 25 years, since the late 90s, that the traders who have more self-awareness are the ones that pick up on those changes in the market and are able to kind of pivot and move and kind of flow with the changes. So self-awareness and market awareness, huge connection.
And when you say self-awareness, is that almost kind of like understanding how you understanding like where you operate the best in terms of kind of like your, that's where journaling comes in and can be a huge attribute, right? In terms of understanding where you've executed your best trades and like what environment those were in, about, et cetera, et cetera. But when you say self-awareness, is that more about kind of like understanding kind of how you execute type thing, or
yeah? I mean, I'll take it a little further than that, and I'll say it's
okay.
To me, I mean, the broad, basic, general definition that I use of self-awareness is for a trader in terms of someone who's an active trader is this: it's how do you respond to risk, uncertainty, and opportunity. Those three things. And you need to be really aware. Do you know how you respond to opportunity? Do you see the market moving without you? FOMO. How do you respond to risk? Having to accept risk, having to put risk on, having to accept a loss. Do you get freezing up with too much opportunity, too much analysis paralysis? So the idea here is understanding and really deepening your awareness of how opportunity, risk, and uncertainty, how you experience those things and how you respond to those things. That, to me, that's what self-awareness is.
That's fabulous. I mean, it's so perfect. I mean,
because I've been doing this myself, man. I'm a trader myself. I think that's why my clients like it.
Yeah, it's perfect. I mean, I can see exactly. I fully understand now what you mean by self-awareness, because that's. Sorry, my brain's like literally processing this as we're speaking here. But that was fabulous. Awesome, Brad. Did you have anything along those lines that you wanted you to expand on or anything like that? He might.
No, I think look, Andrew can help everybody, and anybody else that's got questions should benefit from it. Age helps. right?
Mm-hmm.
I'm over
Experience.
50 now, so yeah,
Mm-hmm.
it's a Bear Stearns is a long time ago, and I'm actually hoping for the next Bear Stearns so I can take advantage of the Brads from 15 years ago. So Andrew,
Yeah.
thank you for joining us.
Yeah.
Yeah.
Just one quick little
Oh,
thing.
so
Some years,
yep.
remember the flash crash back when was it? I think it was what 2010 or
Yeah, you
2011,
said
whenever that was, the big
Sure.
oh
one.
yeah, sure. Yeah, 2011, right?
Yeah,
Yep.
about I don't know, about 10 or 11 months after that, Wall Street Journal contacted me and interviewed me and asked me about what I was seeing, if with my clients coming up on the 1 year anniversary of it, and what I mentioned to them, and they did a little article on it about my when they interviewed me. It's on you can see it on my website, andrewmenaker.com. Is I came up with the term flash crash flashbacks, and what I said was that as we're coming up to that May, whatever it was May something. I remember it was May. I'm not sure exactly what day it was, but yeah, a lot of my PMs were starting to get a little nervous about just because the anniversary, even though it may not actually mean anything in a practical way in terms of probability of it happening again on the same day a year later, but just that's the way our mind operates, right? We think in terms of anniversaries. So yeah, flash crash flashbacks. Yeah.
Yeah, I mean, getting rid of your PTSD from old days is a trick, right? I mean, actually, maybe that's a question that you could expound upon, right? Everybody's got some really
Yeah.
failed trades and has to recover.
Yeah. Oh yeah. And one of the things that I realized early on in my work when I was when I was a fresh new clinical psychologist and just began working with traders, and during that period from me going from from school into working with traders, I had a little bit of a period for a few years where I was doing some consulting with the military and other agencies. And what I realized was that when we're traumatized, being traumatized, you mentioned PTSD. That's what made me think about this. Being traumatized, it's very similar to, you know, taking a big hit in the market. It's that experience of being traumatized. And so I realized that, how you respond to trauma um, is a really big deal. So there's a certain element sometimes in my work, not all the time, it depends on the person, that we may actually have to go back and sort of unpack the trauma basically so they can help, get kind of move past it basically.
Yeah, losses. Yeah, managing your losses and kind of not necessarily just compartmentalizing them and shutting them down and shoving them into the corner, right? It's like to your point, like unpacking it and be like, okay, this is, this these puts on Tesla were ill, timing was off, right?
Mm-hmm.
Or my execution in regards to the strike price on a put. I'm just using this as an example, but not because it's from personal experience, haha, wink, wink. But but yeah, the strike price is wrong, or the expiry might have just been a little too early, right? And then so you can go back and review and say, okay, well, listen, the fundamental concept here, or the core analysis, and the process in place was calling out XYZ, and it ended up being correct,
Mm-hmm.
but my timing was off, or when I was getting overly excited about the trade, or overly excited about the opportunity, was really where I made the mistake,
Mm-hmm.
or conversely, I waited too long, right? And then I was worried that I missed it, and therefore I didn't execute on the trade, and then I had PTSD from or sorrow from not from having a great idea that I didn't end up putting on into the portfolio.
Mm-hmm. Yeah. Oh yeah. And that happens, right? That's part of the trading. It's part of trading life.
Yeah,
So that's no escape. Yeah. And
absolutely,
it's how you
absolutely.
respond, right? How you recover from those situations. Really, I think has a huge impact in terms of the arc of one's career. How you're gonna, what your life, your success or not as a trader.
I think you're absolutely spot on. Whether you're, a portfolio manager, investment advisor, a trader, individual investor, whatever it is, I think you're absolutely spot on there, Andrew. And because, again, it's not. I don't want to use compartmentalize, but if you unpack, to use your terminology, if you unpack those mistakes that you've made, and then get up, rise up and move forward, and learn from those mistakes or learn from those actions that you did. I think it can be a massive. It can be it can compound into making you better, right? And then the next time those opportunities present themselves, you feel more comfortable in terms of, going back a few minutes ago, as of what you were talking about in terms of the pattern recognitions. You're recognizing those same patterns, but then you're like, all right, I've seen this before, or I'm comfortable here. I don't mind, I don't mind being in the seat right now because, unlike many others that I'm seeing, and at Hedgeye, we call it kind of the noise, right? So like blocking out that noise. And I do find in this day and age of Twitter and social media and the news cycle, 24/7 news cycle, there's a lot of noise out there. And so, having that, trying to block that out and really just harnessing in on to use your terminology, like, the inner self, the inner market, and being comfortable in the uncomfortable, to kind of steal a terminology from Keith. That's crucial.
Yeah, being comfortable with the uncomfortable. The way I like to say it is learning how to tolerate all the bad stuff we have to tolerate as a trader, right? Missing out, taking losses. I got out and they kept on running without me, and even with my all that stuff, right? So here's what's interesting, guys. This is what was very surprising to me when I first began working with traders. I didn't expect to see this, but lo and behold, I did. And this is what happens, is that whether you're successful or not successful, you're pretty much going to have a lot of the same feelings, like FOMO. Everyone has FOMO, regardless of how much money you're making or losing. Not wanting to or not liking taking a loss. Having a reaction to losses, regardless of who you are, your degree of success or not as a trader, you're going to have the same feelings. The difference is between people who are more successful versus less is that the ones who are more successful are tolerating the same feelings more than the others. So, we can talk about it in different ways, but to me, that's really what it comes down to, is we have to learn how to tolerate, dealing with the slings and arrows of being a trader. That's what it's all about.
And so is that concept kind of letting, to use a very common phrase, like, water off the duck's back, what have you, right? So it's like kind of like once you're done with that, piece of inventory or that position, it's sort of like, okay, you're moving on. It's a clean slate. Is that what you mean by that?
Well, in a perfect world, yes, but the world's not perfect, right? So
no, of course.
so I mean, that's what the books would tell us, right? But in reality, it's not that simple. We can't just close the door on that trade and not have it affect us at all. It's gonna be there in the back of your mind, maybe even more in the front. Who knows? But the idea here is that being realistic with yourself and recognizing that trading involves doing two very disparate, two opposite things at the same time, right? We have to identify opportunity and we have to manage risk. They're pretty much the opposites in a way when you think about it, but we have to do them both, and we have to do them both simultaneously, and we have to do them both equally as well. And that presents a challenge, and most people don't realize that. I think they come to trading. Some people come to trading, different backgrounds, right? From maybe they're like a coder, or they're a lawyer, or they're a previous career, right? And what helped them become successful in that previous career, oftentimes is not going to be helpful, and it could actually be a problem as they're learning to become a trader. So.
Yeah, I had a great conversation with a gentleman who is a retired U.S. Air Force pilot, and he said a lot of things that made you good as a pilot do not, or kind of things that don't make you, that he had to kind of shed or pivot or kind of adjust, because they as a pilot, you're really almost trained to prepare for every situation that could go wrong, right? And you have things that you do, and I'm butchering Rich's terminologies, but there's things that you do when XYZ happens, right?
Yeah.
Versus a trader, there's a lot of unknowns out there, and you have to kind of make your best judgment based on your rules and process that you've built and that kind of thing.
Yeah.
So I think it's a very good point in terms of sometimes those things that make you really good in your one career or your past life, if you're retired or what have you, then they don't always translate to investment management.
And the pilot story is a good one. It reminds me of a client that I was working with some years ago who was had been a commercial airline pilot previously, and then he began trading on his own and became pretty successful and opened up a small hedge fund. And when I was working with him, he had a great line, and he had a bit of a different approach than the pilot you were talking about. But what he said as a pilot, what helped him in his trading as a pilot, he did say there was one aspect of being a pilot that really helped, was that in flying, takeoffs are optional, landings are mandatory. That's what he said, right? You don't have to take off. Well, I guess if you're a commercial pilot, you have to. But if you're just a pilot with your own plane, takeoffs are optional. But once you're in the air, you got to land the plane, right? Plane can't last. Trade's not going to last forever. You got to exit either with a win or a loss. So recognizing that takeoffs are optional, landings are mandatory. So for this guy, he was a former pilot, actually, it was helping him quite a bit, actually.
Yeah. Rich told me a similar thing, and he actually introduced me to kind of a little bit. Basically, he likes leveraging sort of longer dated options. He calls it walking down the mountain rather than kind of catching trying to be catching the elevator at the right level.
Right.
So, yeah, but yeah, no, the landing is not optional. It's a very very good one. I like that a lot. So just again, not to pivot completely, but I see some friendly faces out there that are investment advisors and specifically kind of managing or running their own RIA business. My question, because I know you deal with a lot of kind of business leaders and stuff like that, and as an owner of RIA, you're dealing with sort of not only the trading aspect that we've talked about already, and the kind of portfolio management side of things, but then there's also the business side of trying to grow your assets under management and manage perhaps people that might report into you, et cetera,
and managing client expectations too is a big one.
And exactly, absolutely,
100%. I've had people come to me specifically for help on that.
Yeah. Well, why don't we dive into that one? Because
Well, I mean, there's a lot of things. I mean, it depends on, of course, right, on the size of the fund and how much, what kind of resources you have available and how things are set up. But I mean, you have to decide. It's like, what are you going to report? When are you going to report? What's going to be in the report? And how are you going to handle inquiries and the types of messaging? And it's very important because, people invest money. They want to see, obviously, a positive return. And that just creates an enormous amount of pressure on the manager or the fund manager. And so trading on its own, as we all know, is hard enough. But then when you take on money, it adds an entirely new element, a huge element. In fact, I've worked with traders who've gone from managing money to just trading their own account. And I've gone and I've worked with traders going the other way, who've gone like the commercial airline pilot who was trading their own to opening up a hedge fund, or going from buy side to sell side and vice versa. And it really changes in terms of who your audience is, the stakeholders. It's a very significant impact. And I would just suggest to people, if you're thinking of, like, if you're just trading your own capital and you want to run money, really think about it. Talk to some people who've been doing it, and so you know what you're getting into. And I will just say that, again, I've worked with a lot of traders who've made the transition, and it is harder than people realize.
Yeah, absolutely. No, that's awesome. Thank you. And all right, so we kind of have another 10, 15 minutes here. If anybody's out in the audience, if you guys want to jump up, I see again, George is an owner of an RIA. He's actively putting out Bruce Lee memes out there and gifs, not memes, but gifs. So I don't know if he wants to jump up, but again, this is an open forum. So Andrew's here to take our questions as a friend of Hedgeye Nation. So we'll just kind of give it a minute or two, and while folks maybe come up or not, I can obviously ask more questions. I got plenty of them.
Hey, I like the Bruce Lee reference. I mean,
Yeah,
great book to
be water.
be water,
Right?
my
Yeah.
friend. I mean, one of the great read that I just had in the last year was his daughter's book, Shannon Lee, who actually I think she was only 2 years old when
I haven't read that.
she was only 2 when he died. She never really knew him, but she got access to all
Oh
of his
wow.
old journals, and she has
Oh
a
wow.
really great book, and it's called Be Water, my friend. Shannon Lee, the
Oh
author,
cool.
great, and it's great for trading. I think it's one of the best trading books out there. Never talks about
Wow.
markets or finance, but it's all about how do you get in the flow and how do you stay in the flow and how do you
Yeah,
recognize when you're not in the flow. Yeah.
That's awesome. Yeah, I'm gonna have to put that on my short list.
Mm-hmm.
Yeah, George, welcome, my friend.
So, I love that you just recommended that book because I'm definitely going to buy it. It would have never been on my radar without it. So thank
No.
you.
Mm-hmm.
You've piqued my interest with talking about, balancing being zen and in the moment and being able to execute and managing yourself. I have a very personal investment advisory practice where, people become clients and I'm going to take care of them all the way through their retirement to the point where I'll be at their funeral and I'll be helping their kids with the inheritance and legacy and filing like death claim kits with death certificates at the end. It's to the point where I can feel how
Mm-hmm.
my clients are feeling
Mm-hmm.
without me ever speaking to them because I know what cable news shows they watch and how their group thinks, even though that I'm not personally a part of exposing myself to those things, I'm aware of them. And I'm curious if you have any recommendations with regards to managing being human and empathetic and communicating in an effective manner to clients who may not be going through it the same way the person managing the portfolios and executing is, and
Mm-hmm.
insulating yourself. How do you balance those two things? I know it's easier said than done, but if you just have, one or two
Mm-hmm.
pointers, I'd appreciate
Mm-hmm.
it.
Yeah. Yeah. Well, that's a great question. I mean, it really kind of, to a large degree, kind of cuts to the heart of the matter of when you're a fund manager in many ways. So, I mean, the first thing is you want to, of course, you should know something about your client's risk tolerance, right? And so when you're having a communication with them, sounds like you're kind of doing maybe like a one-on-one thing. You want to keep that in mind. What is this person's risk tolerance? And you want to really keep that at the front of your mind as you're communicating with that person so you can find the right phrases, the right words to say that will not further, well, I'll use the word we were using earlier, traumatize, so you don't trigger them and make them even more anxious. So it's really, a lot of it comes down to choice of words, um, as well as frequency of contact as well. I'll say that too, because I've had some clients that set up these expectations with their clients where they're going to be, very frequent communication, and that can be good or bad. It really depends. And I think it can sometimes, on the bad side, it can kind of feed anxiety or generate anxiety. And sometimes if there's not enough communication, that can as well. But there's a balance point. And I think each client is going to be different. And if you have kind of a sort of a smaller, high touch practice, it sounds like you do, then, being able to tailor how you interact with each of your clients is going to be really important for someone like you. It's going to be different from person to person.
Yeah, I agree with you. Thank you. I appreciate that. I think what I need to figure out is how to best figure out how many touches the person
Mm-hmm.
needs
Yep.
because, when you onboard somebody as part of a fact finder, it might say, how many times do you want to hear from me? Once a month, once per quarter, twice a year, once a year. People don't necessarily put down what they actually require. I'm curious if you've bumped into anybody who has kind of perfected understanding who they're dealing with and how to effectively categorize them and communicate with them.
So George, Andrew, just before you answer
Mm-hmm.
that, so George, when you say they don't necessarily put down what they require, do you mean some folks might need, or some folks might need higher touch, and some might put down more frequently, and they really need less? or vice
Yeah, I
versa?
mean, when you're onboarding someone new and you put them through a fact-finding process, they may not know as much about themselves as they think they do.
Mm-hmm.
Got it.
Mm-hmm.
And it's
So
not until maybe having them as a client for 1 to 2 years where you get to know them and really understand what they need.
Mm-hmm.
And every
Yep.
once in a while, you'll have a new person get onboarded and not last because of miscommunication or misunderstanding. It's rare. It doesn't happen a lot.
Right.
But for someone like me who cares so much, because I'm in the trenches, like I'm on the front line, I feel them. You know, if you're running an ETF or something, you're very disconnected from the people actually putting their funds into your strategy versus sitting down, getting to know all of a person's idiosyncrasies, their hopes, their wishes, their dreams. It's much more personal. So, like, if you onboard 15, 20 people or households a year and just one of them goes wrong, that one hurts way more than the 12 that go great.
Oh yeah.
You know?
Yeah.
Yeah.
I I very much appreciate this question, George, because I experienced similar things as being a key ambassador to Hedgeye Nation, and I feel that, buddy. So
Mm-hmm.
I'm very curious how Andrew might help coach us along here.
Mm-hmm. Mm-hmm. Well, you know, when you have like a smaller practice, not a lot of clients, one possibility, and this is sort of this would be kind of like the gold standard. It may be actually hard to pull off, but you want to have clients that have high degree of self-awareness as well. I think you'd mentioned that earlier. Was it George? Was that who the is that your name? The fund manager? Am I getting this correct?
Oh, yeah,
George, right?
Yep.
So I think George, you mentioned something about the client self-awareness, and you hit on the right idea right there when you said that. Ideally, you want them to be self-aware, and so what can you do to help them be self-aware? Um, I think in a perfect world, it would be great to have clients kind of go through a little bit of an exercise in terms of how do they feel about risk, uncertainty, and opportunity, so they understand that for themselves, right? So then when they're getting information from their fund manager, they can put things into context a little bit. That would be the gold standard. That may not be practical for a lot of fund managers, but that would be the ideal.
Does that make sense, George?
Yeah, it does. I'm a perfectionist, so it's tough. Like, we ask people, like, on a scale of 1 to 10, are you afraid of your own shadow, or are you a riverboat gambler when it comes to your investments? And a lot of times we're dealing with couples, and you're trying to balance,
Mm-hmm.
the husband versus the wife's risk tolerance. And I probably have this down pretty good, but, again, like I said, you onboard 12, 15 households per year. You have one leave after 6 months. You put so much time and effort into people. I don't know. It just stinks because you get to know them really well personally. You want it to make it work.
Mm-hmm.
I'm just looking for a better mousetrap, really.
So,
with regards to getting them to understand
Sure.
their own selves.
Sure.
Because I think asking a question like on a scale of 1 to 10 or 0 to 100, I don't think that's the actual best solution to finding someone's risk
I
tolerance.
agree. What I would suggest is, in fact, I'll just say this: anytime you have something like it's a structured question with like a Likert scale or a 1 to 10 intensity scale, and put your response into this, you're not getting you're losing a lot of valuable information about that person. Ideally, you want to have an in-person interview or Zoom, just where you can see the person, because a lot of what gets communicated is not just in the content; it's in the nonverbal behavior as well. In other words, someone can say that they're okay with risk and they really want to grow their portfolio, their money, and they're willing to take on more risk, but maybe they're not, or maybe it's the opposite. Maybe they talk about being risk averse, but maybe they are more of a shoot from the hip person. So what people are willing to put down on the questionnaire can often be very different to how they would respond to. Maybe ask them some scenarios, put out some scenarios and say, what would this be like if this were to happen? And what would you think about this other scenario if that were to happen? You start to get a sense of how they might react, what's really, going on with this person, who are they really, not not simply what boxes did they check and what numbers on the Likert scale did they circle.
I love that. Thank you.
Yeah, me too.
Different scenarios, both positive and negative, and then see their reaction, read their body language.
The body language is huge, man. The vast majority of what gets communicated is nonverbal. I learned this doing threat assessment a long time ago, many years ago, working with people who were, trying to talk people down who were about to commit an act of violence, right? And so it's not just about what they're saying; it's about reading their body, their behavior, and their nonverbal behavior is really important.
And again, George, just to kind of expand on that, to me, right? Like we're in a bit of a new environment at the moment, right? Where interest rates or just generally, the 10-year in Germany and UK are at 10+ year highs. We're hitting all-time highs again on the not all-time, excuse me, near-term highs in terms of taking out the most recent high in the U.S. 2-year Treasury from last year. So you're at an environment right now that many folks, whether especially that you're onboarding, they haven't experienced interest rates really north of 2% for a really long time, and so 4% on the 10-year, I guess, really, or 3% on the 10-year. But my point is that getting a reassessment as to what are their what situation, right? Are they what happens if, again, I'm using extreme. What happens if, 30-year Treasury, yields 10%, right? So what kind of environment are they? Again, I think it really depends on the investment criteria that they have and all that kind of stuff. But these extreme situations are helpful because I'm sure it would help you better manage their money and really put them into the investment. Or kind of put them into the buckets of investment criteria that like best suit them and best fit them.
Yeah, I gotta say, the one thing that I've really been emphasizing in one-on-one meetings has been the paradigm shift. The fact that we have risk-free rates close to 5%, something we haven't had in 15 years. So when you have people, 70, 75 plus, you're trying to tell them, hey, we can actually get you over 4% now without
having put on like serious risk.
Yeah,
right?
and I'm
exactly.
talking to people about doing
you don't need
savings
dividend
accounts
income
and CDs.
Exactly.
That's something that I've never done in my career. But it's kind of funny. And then on the flip side, you're talking to people still in accumulation phase and trying to, tell them that QE, buy the dip, no recession in 14, 15 years other than the 2-month pandemic recession. And that, that phase is over too. So balancing those two messages is important. I really thank you for coming on and talking to us because probably going to go back and rewrite my newsletter, which was like 80% written.
Yeah.
You guys had some light bulbs come on for me, so thank you for doing this. It was a big value add for me.
Good.
Yeah, George, just before you, don't jump off quite yet because I love to hear. So Andrew, and again, I know we're pushing on the hour, but just to kind of finish off this thought from George, because I think it is, we do have a lot of investment advisors, within Hedgeye Nation, and I think this is where I'm taking this question. I hope will be a good one to finish on, and again, we also have a lot of individual investors as well who may be kind of new to trading, so or new to kind of trying to manage their, they're sick of their sick isn't the right word. They want to take control of their assets, and Hedgeye does give them great investment research to help build their process and execute on that. So where I'm going with this question is for folks that again maybe not quite members of Hedgeye Nation, but as an advisor, or if you're kind of very much new to the game, what are some ways to help kind of communicate, right, or to kind of help kind of manage maybe expectations, or just kind of really manage kind of like client, kind of better manage the client, right? So like if to George's example, right, and if he's got somebody that's in wealth accumulation phase, so he's they're a younger couple, and they're used to sort of last 10, 15 years where they could put it in betterment and have multiple various ETFs, right?
Mm-hmm.
That would
Mm-hmm.
just, basically grow at 5 to 12%, any given year, and that's what they're kind of used to. Versus now needing perhaps, certainly, more risk management profile, perhaps having a bit more kind of fixed income in their portfolio. Just again, just like as we navigate these waters, et cetera, et cetera. But for folks that basically might not be as intimate with like the trading and risk management and portfolio management side of what we all do and what we all love, that are likely listening into this call, how would you kind of advise folks to kind of either educate those clients and like kind of better
Mm-hmm.
communicate with
Mm-hmm.
them, or conversely, if you're kind of trying to take this on in your own kind of portfolio and managing your own kind of retirement account,
Mm-hmm.
how can you kind of like almost quote unquote level up
Yeah.
faster?
Yeah. Great question. So there's a lot of different ways. So the one,
Yeah, I'm sure there are.
I spend a lot of time talking about this with my clients. So one of the ways is this, and this can apply to both the fund manager as well as to just somebody trading their own capital. I'll try and sort of address both angles of this. But what you want to do is, when you have your fund manager or trading your own capital, right? There's these outcome goals, right? Whether it's like a benchmark or people have a dollar amount or a percentage or bips in their head, certain things they want to achieve. And those are outcome goals. What I would suggest that the fund manager should do, as well as if you're just managing your own capital, what you do with yourself is don't simply identify and look at outcome goals, but also try and identify and explore what we call in psychology identity goals. So outcome goals are like, what do you want to achieve, right? And an identity goal is
right,
who
like
do you want to be?
buying a second house
Yeah,
or something.
exactly. Yeah, buy a second house, want to retire, want to grow my nest egg, or I want to preserve capital, grow my wealth, whatever it is.
Yep.
So who do you want to be? Who are you now, and who do you want to be in 5 years, 10 years, 15 years? Who do you want to be? That's the identity goal. And then the follow-up question with that is, what does that person need to do? What needs to happen for you to be that person? And so that could involve, right? It may have to involve tolerating some risk, right? Or FOMO, or all kinds of things. So the idea here is don't simply, for both the fund manager as well as an at-home just trader doing their own thing with their own capital, don't only think about outcome goals. Think about identity goals. Who are you? Who do you want to be? And what do you have to do to be that person?
That is absolutely brilliant. I just wrote that down in the notebook. It's not just about the outcome goals; it's about the identity.
Sam, I wrote
goals.
that down.
Mm-hmm.
That is absolutely, Andrew. That is brilliant. And you saved it to the end too, my man.
Now, there's more where that came from. Maybe next time.
Well, good. Well, let's do this. Let's make sure it's not a year between our conversations. All right,
sure.
Andrew.
Hit me up
buddy.
anytime.
This is fantastic. I'm so grateful again for your time. Thank you very much. And for all those listening in, this replay is obviously available here in Spaces, and we're gonna I'll put it up on our various podcast channels, YouTube's on Hedgeye. And just to finish off here, we've got Andrew was part. I don't know when was the book written, Andrew? The Traders at Work. I know you have a chapter in there.
So I was interviewed. It's not my book, but there was one chapter all about me in there. It was 2012 or 2013, actually.
Okay, cool.
Yeah, it's been about 10 years. It's been a long time. Yeah. But what's funny, the guy interviewed me, he didn't really ask anything about psychology. It was really more about my trading.
Yeah. I haven't had a chance to read the book, but it's no offense, but it's going to get it's going to go in the second queue behind the Bruce Lee one.
Yeah, I would put the Bruce Lee book first as well. Yeah.
Awesome. But for those that are interested to learn more about how can Andrew trades and then thinks about trading, the book's called Traders at Work by Tim Borkin and Nicholas Mango. And then you can find out a lot more. He's got some awesome blog posts and all about his services on andrewmenaker.com on his website. So you can kind of Google him or just go to his Twitter handle and everything's there. But thank you again, Andrew, for your time. This has been an awesome coaching session, and very, very grateful for it. So thank you, sir.
Thank you, Rob. Glad to be
Alrighty.
here. Yeah.
Absolutely. All right, guys. Have a great evening, and we will see you, everybody, next week. Well, we actually got a beginner's guide tomorrow morning, 11:30. So check that out. That'll be in the arena within Hedgeye, and then next week we're back with weekly notebook review here on Twitter Spaces at 4:30 p.m. All the best, everybody. Have a good one. Be water, my friends. Be water, right?
Yeah.
Amazing. Awesome. Thank you.